Imagine this. You have worked hard, saved money, and now you are sitting on a pile of cash. But here is the problem. You are not sure what to do with it. Should you invest it? Where should you invest it? How do you make sure you do not lose it all? Some people in this situation end up making expensive mistakes. Others hire a secret weapon, someone who makes sure their money works harder than they do. That person is called a money manager. And in the next few minutes, you are going to discover exactly what a money manager does, how they could help you, and one thing they will never tell you up front, but you will want to know before hiring one. Number 1. What exactly is a money manager? A money manager is like the pilot of your financial airplane. They are professionals who decide where your money goes, when to move it, and how to grow it safely. If you think of your money as a garden, a money manager is the gardener who knows what seeds to plant, when to water, and when to trim back the weeds. For example, if you have $50,000 sitting in a savings account earning almost nothing, a money manager could build you a portfolio of stocks, bonds, and other investments that could grow it much faster over time. Number 2. Who hires a money manager? You might think only billionaires have money managers. Not true. While the ultra-rich do use them, many middle-class professionals hire money managers once they have enough savings to invest seriously. For example, if you have a retirement account worth $200,000 and no idea how to manage it, a money manager could be worth considering. They are often hired by busy people who want their money to grow without having to check stock charts every day. Number 3. What do they actually do every day? A money manager's job is part detective, part strategist, and part coach. They study the markets, looking for opportunities and risks. They make decisions like, should we buy more of this stock? Or, should we sell these bonds before interest rates rise? They rebalance your investments so you are not overexposed to risk. They also talk to you about your goals, such as retiring at 60, paying for your kids' college, or buying a second home. For example, if your dream is to retire in Florida in 15 years, your money manager will create a plan that aims to make that happen. Number 4. The difference between a money manager and a financial advisor. This is where people get confused. A financial advisor gives advice. They might help you make a plan, explain insurance options, or give budgeting tips. A money manager takes it further. They actively manage your investments. Think of a financial advisor as the architect who designs your house, and the money manager as the builder who constructs it and maintains it. Number 5. How do they make investment decisions? They use research, market analysis, and sometimes computer algorithms to decide where to invest. They look at factors like company earnings, interest rates, global events, and even investor psychology. For example, if inflation is high, a money manager might move some of your portfolio into assets that tend to do better during inflation, like commodities or real estate investment trusts. Number 6. Do money managers guarantee profits? Absolutely not. No matter how smart they are, they cannot control the market. But their goal is to maximize your returns while managing your risk. Think of them like a skilled driver in a rainstorm. They cannot stop the rain, but they can keep you from sliding off the road. Number 7. How much does a money manager cost? Most charge a fee based on a percentage of the money they manage for you. A common rate is around 1% per year. So if they manage $500,000, their fee would be around $5,000 a year. Some may also charge performance fees or flat fees. For example, if your account grows by $50,000 in a year, some managers might take a small cut of those gains in addition to their base fee. Number 8. Why some people avoid hiring them. Some people do not like giving up control of their money. Others feel the fees eat into their returns. For example, if your investments grow by 6% in a year, but you pay a 1% fee, your actual growth is closer to 5%. This is why it is important to weigh the value they bring against the cost. Number 9. How to choose the right money manager. Do not just pick the first one you meet. Check their track record, experience, and whether they are a fiduciary, meaning they are legally required to put your interests first. Ask them how they make decisions, how they handle risk, and what kind of clients they usually work with. For example, if you are focused on long-term retirement savings, you probably do not want a manager who mainly trades high-risk cryptocurrencies. Number 10. The types of investments they might use. Money managers often use a mix of stocks, bonds, mutual funds, exchange-traded funds, and sometimes alternative assets like real estate, gold, or private equity. For example, if you are 30 years old with decades before retirement, they might put more of your money in stocks for growth. If you are 65 and retiring soon, they might shift you toward bonds and safer investments to protect your wealth. Number 11. How they manage risk. Risk management is a huge part of the job. They make sure your investments are diversified, meaning you are not putting all your eggs in one basket. They also use stop-loss orders, hedging strategies, and regular portfolio reviews. For example, if tech stocks suddenly drop, having investments in healthcare, energy, and bonds could help cushion the blow. Number 12. The technology they use. Many money managers use sophisticated software to track your portfolio and market trends. Some use AI-powered tools that can spot patterns humans might miss. For example, if the software detects that a particular sector is heating up, the manager might investigate and decide whether it is worth investing in. Number 13. The secret they do not advertise. Here is the loop I promised to close. A good money manager can help you grow your wealth, but you still need to be involved. No one cares about your money more than you do. Even the best manager needs you to clearly communicate your goals, risk tolerance, and life changes. For example, if you suddenly decide you want to buy a house in 2 years, your manager needs to know so they can adjust your investments accordingly. Number 14. How they handle market downturns. A skilled money manager does not panic when the market drops. Instead, they look for opportunities to buy quality investments at a discount. They may also shift your portfolio to safer assets temporarily. For example, during a recession, they might increase holdings in consumer staples, which tend to be more stable when the economy slows. Number 15. How they work with taxes. Money managers often coordinate investment decisions with tax strategies. They might sell certain investments at a loss to offset gains elsewhere, a tactic called tax loss harvesting. For example, if you made a profit selling some stocks, they might sell a losing investment to reduce the amount of tax you owe. Number 16. How they set up regular reviews. A money manager does not just make a plan once and leave it alone. They meet with you regularly, often quarterly or annually, to review progress. For example, if your income changes or you inherit money, they will update your investment strategy to match your new situation. Number 17. How they help with major life changes. Big events like marriage, divorce, having kids, or retiring can change your financial needs overnight. A money manager adjusts your investments so you are always prepared. For example, if you suddenly have a child, they might set up a college savings account and begin investing for their future education. Number 18. How they track performance. A money manager keeps detailed records of how each investment is performing. They compare results against benchmarks like the S&P 500 to see if your portfolio is on track. For example, if your portfolio is underperforming the market, they will investigate and make changes to improve results. Number 19. How they prevent emotional investing. Many investors make poor choices when emotions take over, buying high when excited, selling low when scared. A money manager acts as a rational voice, keeping your strategy steady. For example, if the news headlines cause panic selling, they may advise holding your positions until the storm passes. Number 20. How they teach you along the way. Good money managers explain their choices so you understand what is happening with your money. They help you become a smarter investor over time. For example, they might walk you through why they chose a certain stock or why they are rebalancing your portfolio. Your money is like a car. You can drive it yourself. But if you want a smoother ride and a better chance of reaching your destination safely, a money manager can be the professional driver you hire. The question is, if you had someone managing your money right now, what would be the first goal you would ask them to work toward?